All right. Shall we pray? Heavenly Father, we thank you so much for another wonderful opportunity like this. We pray that as we are about to learn, you grant us the wisdom and understanding so that that day we can reproduce and pass our exam. In Jesus' name, I will pray with thanksgiving. Amen.
Amen.
Now, we are looking at financial assets and financial liabilities. Now, there is something that I want to talk about before we solve this set of questions. That is the recognition criteria for financial assets. We know that financial assets are classified into three: at amortized cost, at fair value through OCI, and then at fair value through P&L. How do you know that this financial asset should be at amortized cost or should be classified at fair value through profit or loss or OCI? The whole classification of financial assets is developed from a model. That is classification of financial assets. We have basis for classification. We have the business model objective. And then we have the contractual. Yeah, I wish I could write those things here rather. Let me do those things here. That solve the questions. Okay, so we have the basis for classification of financial assets. We have classification of financial assets. We have the basis for the classification. Basis for classification. Now, on the basis of classification, we have two. That is, the three classification is based on the following. So what I'm trying to say that these two things that I'm going to talk about, that is what you are supposed to use to determine whether a financial asset is at amortized cost, at fair value through OCI, or at fair value through P&L. Take note of that. Very simple and straightforward. Okay, so now we have the business model, objective. And then we have the contractual cash flow test. So we mean the characteristics of the cash flow. So under the business model objective, we are asking, what is your purpose? What is the motive for buying the asset? Under the contractual cash flow test, we are looking at the characteristics of cash flow. Does it include both principal and interest? Or it includes only interest? It includes only principal? Okay. So after this, they now did the classification based on, they were looking at the two types of financial assets. They are looking at two types of financial asset. That is, whether it is a bond a bond. What I mean is that whether it is a loan note, a bond, that is a liability instrument. Okay, so bond, loan note, debenture, or it is on equity shares. In all this, we say that we have what? Investment. So we'll be looking at how to classify bonds or debenture or loan notes. That is how to classify loan investment. Then we'll look at the classification for equity or investment. I just want to give you a summary before we pick the questions. Now, under loan investment, we'll be looking at these things. If it is financial asset at amortized cost, then the business model objective is to keep or hold the assets until maturity to receive contractual or cash flows. And the cash flow characteristics, that's the characteristics of the cash flows, are principal and interest. That is at amortized cost. Then if it is at fair value through OCI, then I've told you that once you want to know the classification, two things. Ask, what is the business model objective? Two, what are the characteristics of the cash flows? So what is the business model objective? If the business model objective is to keep or sell, or sell, that is, you are keeping it, but anytime you get to know that the value is up, or you expect that the value will fall, you will sell it. Or anytime, at any point in time, you would want to sell that asset. You understand? It means what we are trying to say, that you don't have intention of trading in that asset. You are keeping it, and at any point in time, you may want to sell it. You are not selling it to acquire another asset, no. So to keep, if your business model objective is to keep or sell that financial asset, then it's at fair value through OCI. The contractual cash flow characteristics. The characteristics of cash flows are principal and interest on principal amount outstanding. Because you intend to sell, we want to know whether you have sold any part during the year. If you have sold any part during the year, then the interest will be based on the remaining carrying amount of the investment. Okay. Then we have financial assets at fair value through profit and loss. This one, the standard state all other. If it does not meet any of these two classifications, then it should be under fair value through profit or loss. All other debt instruments, all other debt instruments are classified as what? Fair value through P&L. But you must understand what we call the option to designate a financial asset at fair value through profit or loss. So the standard says that on initial recognition, the entity may by an irrevocable election opt to designate a financial asset at fair value through profit or loss. If doing so eliminates or reduces a measurement inconsistency, also known as accounting mismatch. In other words, on initial recognition, the entity can make a decision that is irreversible to recognize the financial asset at fair value through P&L. But the purpose for doing that should be to reduce an accounting mismatch. Accounting mismatch, we're only looking at a measurement inconsistency in recognizing the element of financial statement. So it is because of accounting mismatch. That is why, as you capitalize borrowing costs, any investment income earned during the period of capitalization should be used to reduce the amount that is what capitalized at borrowing costs. So, assuming the investment income is earned in a period where borrowing cost is not capitalized, the tenant says that the finance cost or the borrowing cost incurred is expense in the P&L. Because of that, the investment income also goes there. Once you do otherwise, you create an accounting mismatch. We have a lot of that in most of the standards. The one on IAS 16, revaluation gains and losses. Anytime you go against a matching concept, you create an accounting mismatch. We are saying that incomes and then the related expenses for a particular period, you must make sure you recognize it in the same period. The income for the item cannot be taken to P&L, while the expense for the same item is taken to OCI. No. So if the purpose is to reduce an accounting mismatch, you can have an option to designate it at all fair value through P&L. So this is just a summary. That is for loan investments. Then when it comes to equity investments, equity investment cannot be measured at amortized cost. Why? Because the characteristics of the cash flows are not principal and fixed interest. However, it can be classified as what? Either fair value through P&L or fair value through OCI. If it's at fair value through P&L, that is the default method. All equity investment, unless otherwise stated, it is measured at fair value through P&L. But if it is held for trading, then it becomes compulsory to treat it at fair value through P&L. If it is held for trading. But if it is not held for trading, then you can have an option to designate as what? Fair value through OCI. Remember, changes in fair value goes to OCI, but dividend income is recognized in the P&L. So take note of this. This is just a summary so that as we solve the questions, we solve our throughout. Okay. So let's now take question 1. Those who want to take the shot for this one, for you. You can first take the shot. Some seconds. Once you are done, you can take this shot as well. Okay, now let's move to solve question 5. This is part 2 of the questions. Part 2 of the questions. We've done part 1, question 1 to 4. So question 5. On 1st January 2011, Thomas bought 100,000. Down the line where this word bought. Take note. Once the entity is the one buying, once you see Thomas bought, Thomas purchased, Thomas acquired, Thomas invested, Thomas loaned, this word denotes the fact that you have a financial asset. So if it's a debt instrument, you have a loan investment. If it is shares, you have an equity word investment. Once the entity is the one buying, the entity has a financial asset. Take note of that. So the word or the underlying bought, underlying word bought is important. It is that verb that is telling us that it's a financial asset. Thomas bought 100,000 5% bond for 95,000, incurring issue cost of 2,000. Interest is received in arrears. The bond will be redeemed at a premium of 5,960 over nominal value on 31st December 2013. It means that the nominal value is 100,000. So the redemption value in this case, it means that then the redemption value, we expect that it will be 100,000 plus the 5,960. Okay. They said that they bought it for 95,000. This 95,000 here means that it was bought at a discount. It means that they were given a discount of 5,000. So you should take note of that one too. The bond will be redeemed at a premium of 5,960 over nominal value on 31st December 2013. The effective interest rate is on 8%. The fair value of the bond was as follows: 1st December 2011, 110,000. 31st December 2012, 104,000. Explain with calculation how the bond would have been accounted for over all relevant years if A, Thomas' business model objective. Business model is to hold the bonds until redemption date. So let's take the first one. If Thomas decides to hold the bond until redemption date, you see that the bonds pays interest and then there's a capital amount. And their intention is to keep some until maturity. So it becomes a financial asset at amortized cost. Because the business model objective is only to keep. Thomas has no intention of selling the asset before the redemption date. Then B, Thomas' business model objective is to hold the bonds until redemption, but also to sell them if investment with higher return becomes available. In that case, the business model objective is to do what? Is to keep and as well sell. So it will be at fair value through OCI. C, Thomas' business model is to trade bonds in the short term. Once the business model objective is to trade in it in the short term, then it is at fair value through P&L. They just buy, sell within the short term. So the first one is at amortized cost. The second one is at what? Fair value through OCI. The last one is at what? Fair value through P&L. Very, very important. So let's take the A. So A. Did that A. The characteristics, we say that the financial assets is measured, or the financial assets should be measured at amortized cost, because the business model objective is to keep the assets until maturity. Until what? Maturity. Until maturity. It also meets the contractual cash flow test. That is the characteristics of the cash flows. The characteristics of the cash flows are mainly interest and what? Principal. In fact, you must meet the two conditions concurrently. So because it is at amortized cost, this is what is going to happen. On initial recognition, that is at inception. On initial recognition, we'll pick the fair value, which is the 95,000. It was at a discount. They have deducted the discount, which is what? So it's now 95,000. Remember, I said it's 95,000 because the person has already deducted the discount for you. Then there's an issue cost. When you talk of the initial amount to recognize, financial assets, the initial amount to recognize, you always add the transaction cost. We are looking at the net amount that you paid to acquire the assets. So you pick the face value you paid. You didn't pay for the discount, so you deduct. The discount is again. The issue cost, the transaction cost, you paid. You are the one buying. You engage the services of an agent for which you pay the commission. So money is going out. It will add up to the net amount that you pay. With the exception of financial asset at fair value through P&L, this one transaction costs are always expense in the P&L, whether liability or assets. Once it is at fair value through P&L, transaction costs are expense in the P&L. Apart from this, all others, remember that for liability, we deduct transaction costs. For assets, we add transaction costs. If it's a financial asset, we are looking at the net amount paid. So you add the transaction cost. If it is a financial liability, we are looking at the net amount received. That's why we deduct the transaction cost. If you are the issuer, you don't receive transaction cost, you will pay. You are looking at the net amount received, so you take the transaction cost out. But if you are the buyer, we are looking at the net amount paid. You pay for the fair value, which is the face value minus discount. Then you also pay for the transaction cost. So we add the two. But if you are an issuer, then you receive money for the fair value, which is the face value minus the discount. And then you pay issue cost, transaction cost. So you take it out. So financial liability, we deduct transaction cost. Financial asset, we add transaction cost. Take note of this. Very, very important. Okay. So there's a transaction cost of 2,000. So you say transaction cost, we add 2,000. So that will give us 97,000. So the bond is redeemable in 3 years' time, right? So after that, we'll do our amortization for 3 years. But per the question, they want us to do for only 2011 and 2012. But let's do all. For the amortized, let's do all. So amortization. So 2011. 2011, 2012, 2013. So let's see. We have balance at start. We have the effective interest at 8%. Effective interest at what? 8%. The nominal interest at 5%. Then we have balance at year end. Okay. So let's start. We have 97,000. So 8% of 97,000 give us how much?
7760.
7760. And then 5% of the face value. The nominal is always on the face value. It's always on the face value. So that is 5% of 100,000. I
That's
told you that the face value is
5,000.
100,000, and then they give a discount of 5,000.
That's
so 5% of 100,000.
5,000.
5,000. So we deduct the 5,000. How much will we get?
That's 99760. 99760.
We have 99760. So 8% of 99760.
That's 7981. 7981.
If you have any question, kindly send it on the chat session. I'll come and address it for you. If you have any question on the chat session, kindly send your question there. All right, let's continue.
That's 102,741.
102,741.
741.
So 102,741. So 8% of that will give us how much?
8219.
8219.
Yes.
So when you do that, you get how much?
That 105,960.
105,960.
960.
So you see what is happening. That's what they said. The redemption value is 5,960. So when you add it to 100,000, you get 105,960. It tells you that what you have done is correct. So after this, it's just a matter of copy and paste. But remember, you are now a buyer, so you have an interest income. So we have for all the relevant years, we have income statement. The name is Thomas. So Thomas Limited. Income statement. Extract. Income statement extract. For the year ended 31st December 2011, 2012, 2013. So we have P&L, that is interest income. So we have 7760, we have 7981, we have 8219. We have 8219. The level 3 student, we are reminding you of the fact that, so let's move to the statement of financial position. We have Thomas Limited. That is a statement of financial position. Level 3 student, we are reminding you that in your question, everything can be inside. It is level 2 that sometimes they restrict them. I mean, they don't bring everything. They just look at just those initial issues, the preliminary ones. So you take notes. As at 31st December 2011, 2012, 2013. So we have non-current assets. Non-current assets. Under non-current assets, we have investments. Loan investments. So how much? 99,760. Then under current assets. Under current assets, we have investments. Investments. That is the one in 2012. That is 102,741. So this is A part of the question. The B part of the question says that what if you want to keep and then sell? So the B, we say that the financial assets.
Hello, sir.
Yes.
Sir, the investment, I thought you said the one at the 2012. You picked the 2031, the 102. I thought you have, okay, that's all. Thank you, sir.
Yeah. So this is 2012. Okay.
Yes.
So B, the financial assets should. Okay, so let me wait and see if there's question on YouTube. YouTube, any question? Those watching us from YouTube, thank you for watching. Like the video and then you can share to your friends. It's free. Make sure you subscribe and press the bell so that whenever we are live, you can get notifications. Okay, so the financial assets should be measured at fair value through OCI. This is because the entity, this is because Thomas intends to keep or sell before redemption date. In that case, the initial amount to recognize will be the same. Initial amount to recognize. Initial amount to recognize. So we have the face value minus the discount, less discount. That has been given to us 95,000. That is the fair value. Then we add the transaction cost. The transaction cost is 2,000. The transaction cost, which is 2,000, that will give us 97,000. Subsequently, what we do is that we measure it at fair value. So we'll prepare our income statement straight away. Income statement. So P&L. So in your P&L account, you have, let's check the fair value at the end of 2011. At the end of 2011, it's 110,000. So there's going to be a fair value gain. And then at the end of 2012, it's 104. So let's see. So P&L, fair value gain. That is for 2011. So in this case, they want us to look at only 2011 and 2012. 2012. There's a fair value gain of 110,000 minus what? 97,000. That will give us 13,000. Is that not it? Then in the statement of financial position, financial position, there's a fair value amount. So we are talking of 2011 and then 2012. We are going to have non-current asset investments. That's how much? 110,000. But in 2012, it had fallen to 104. So there's going to be a fair value of loss of how much? Of 110,000 minus 104,000. We can go and cross check from the question. You can see they said 104 this at the end of 2012. So that will give us 6,000. Okay. So this one will be 104,000. So that is the statement of financial position as well. Very simple. Now, if it is at fair value through P&L, that is, they said it is, they want to trade in it in the short term. So the C part, you see that since Thomas intends to trade in the instrument in the short term, it must be measured at fair value through P&L. In that case, the initial amount to recognize is going to be the face value, which is face value less discount, which you know is 95,000. Remember, transaction cost and the fair value through P&L is expense. So in our income statement, we are going to have P&L. There's something, I think there was a mistake somewhere. Let's correct it. This one, you know that it is not in a P&L. OCI. You said it's at fair value through what? OCI. Let me see. Yes. So this one should be other comprehensive income. So remember. So because it is under OCI, I mean the B part, then under equity, we have capital surplus. That will be taking the gains and losses. The first one was 18,000, then there was a loss of 6,000. So it reduced it to 7,000. I believe you understand. The second one, it is at fair value through OCI. It is the third one that is at fair value through P&L. In that case, P&L is going to take the transaction cost. The transaction cost as an expense. That's how much? 2,000 as an expense. Then we recognize fair value gain. Fair value gain. That is 110,000 minus 95,000. That will give us 15,000. Then we recognize fair value loss. Fair value loss. Fair value loss is 110,000 minus 104. In 2012, it's fair. So that will be how much? 6,000. So very simple. In the statement of financial position, this person is to illustrate all the three classifications and how it works. Okay. No examiner will give you this one. No. It will not be plenty like that. Okay. So, in the statement of financial position, statement of financial position for 2011, 2012. So you write non-current assets, investments. The figure is 110,000 and then 104,000. That's all. Nothing goes to equity because the P&L is part of a double entry, remember. Okay, so that is it for the question. Those who want to take a shot, let me reduce it for you. Now let me take your questions. If you're on YouTube, if you are watching us on YouTube live, kindly send your question on the chat session. I will just address it for you. You can take a shot if you want to. Let me address your questions on YouTube live. Any question? Any question? Like the video. Only 8 people have liked the video, but 33 are watching. So can you like the video and then subscribe to the channel if you have not done that? Subscribe to the channel. And once you subscribe, press the bell so that anytime we are live, you can receive notifications. Okay. Like the video and subscribe to the channel for us. Okay. So let's move. Can take a shot of this as well. Any question? Any question, please? Any question? All right, so if there's no question, we will take question 35. Question 35. Madam, if you have any question?
No.
You understand? Okay. So what I will say, do I know you'll be joining us on YouTube, so if you have any question, you can always ask.
No, I'm okay, sir.
Okay. All right. All right, so let's move and insert the next question. That is question number 6. Question number 6. So question 6 is on the board. On 1st July 2018, AC Limited purchased 5,000 debentures issued by Ion Limited at par value of 100 cedis each. It means that the face value is face value is 5,000 times 100. So we can see that that is 500,000. They said 5,000 debentures at 100 cedis each. The transaction cost associated with the acquisition of the debenture was 24,000. So we have the transaction cost, 25,000, 24,000. Coupon interest rate is 11%. Take note here. The coupon interest rate is 11% per annum, payable annually on 30th June. So the first year will be 2019. 2019 financial year starts from 1st July 2018. Take note of that. So the fact that you have seen 2018 does not mean that the first year is 2018. The first year ends on June 2019. 30th June 2019. So June will be the first year. Take note of that. Okay. On 1st July 2018, the effective interest rate was worked out at 9.5%. That is on the date of the agreement. It was 9.5%. So that is the effective interest rate, 9.5%. Whereas the market interest rate on similar debentures was 11%. That is, the market interest rate on similar debentures were at what? 11%. We don't care about that. We care about the fact that the effective interest rate based on the transaction cost and everything is what? 9.5. Don't use the 11%, use the 9.5. As on 30th June 2019, the debentures were quoted on Pakistan Stock Exchange at 96 cedis each. Prepare financial statement for the year ended 31st June 2019 if the investment in debentures is subsequently measured at amortized cost. If it is measured at amortized cost, then the initial amount to recognize A at amortized cost. Initial amount to recognize. Initial amount to recognize The initial amount to recognize will be the face value, which is the 5,000 times 100, giving us 500,000. Then we add the transaction cost. We add the transaction cost. We add the transaction cost. How much? They said 24,000. We get 524,000. 524,000. Okay, so now we carry this at amortized cost. Remember they said you should do for 2019. I believe now you understand, so I'll get it for 1 year. So we have the amortization. So we have the year 2019. Balance at start will be 524,000. Effective interest at what? At 9.5%. Nominal interest at what? The nominal interest at what? So that the coupon interest rate is what? Is 11% per annum. These are how we get it. But the effective interest rate is 9.5. Okay. So this is at 11%. Then we have balance at year end. So 9.5% of 524,000 give us how much?
49780.
49780. And then 11% of the face value, 500,000. This is always on face value.
That's 55,000.
55,000. So how much are you getting? When you add them, how much are you getting?
That's 518,780. 518.
Okay,
No.
518.
Yes, 780.
780. 51. Okay. So in our income statement, we are going to have interest income. Now P&L. We have interest income. That is 49780.
Solomon Kosha.
Then in the statement of financial position, statement of financial position. We just write non-current assets. So we write investments. The value is how much? 518,780. That's all. Okay. The B part of the question the B part of the question. Let me see. I have some questions here.
Sir, please, I'm leaving you. Thank you.
Okay. So the B part of the question. How did we get the 7,000 and the capital surplus? So it's referring to question 5. You know, the first one, we had the surplus of 13,000. Then there was a loss of 6,000 in 2012. So the net gave us the 7,000. Another one from CFAS. With the second model in the income statement will be OCI. I think it's OCI. I corrected it. It's OCI. Then Hannah Yomu. Why are we using the effective interest rate of 9.5 and not the 11% of other bonds? No, this one is not compound. This is financial assets. You have worked one for yourself, and you said the effective interest was 9.5%. Why would you want to use the one on the market? The one you have calculated yourself is entity specific. You have factored your transaction cost. You understand? So use that one. Okay, so let's move. The B part said that what if it is true profit or loss? Let's go and check the B part of the question. You say that, yes, fair value, true profit and loss. That's why you know that transaction cost would have to be what? Expense, remember. So, B. Fair value through profit or loss. What do we do? Initial amount to recognize. Initial amount to recognize is going to be how much? The amount of 500,000, the one we calculated. We don't add the transaction cost. So we go to P&L straight away. So income statement. So P&L. So on the P&L, we have the transaction cost. It will come as an expense. Transaction cost. It will be there as an expense. How much? 24,000. Then we look at the end of the year. They said that it has moved to 96 cedis each. Instead of 100, it has fallen. So there's going to be fair value loss of 500,000. 500,000 is the value at the beginning. But if you check at the end, it's now 96 cedis per one. So 96 cedis times 5,000 will give us something. How much? 96 cedis times 5,000 give us how much? If you are
480,000.
480,000. So minus the 500,000 give you how much? 20,000. Right?
Yes.
So in the statement of financial position. Statement of financial position. We have non-current assets. We have investments. Investments. Investments give us how much? The 96 times 5,000. I'll give us 480,000. That's all for the question. That's all. Very simple. So those who want to take a shot can do that. Can take your shot. Ask questions. Those on YouTube, ask questions. Question from Hannah Yomo. I think I've answered that. Question from Honorable Alfredana. Since it's not for a year, is the asset current or non-current? No, what is happening that in our case, we're not told the redemption date. So you treat it as non-current. You don't know when it's redeemed. We're not told. Okay. So any other question? Otherwise, we move straight. We move straight to the next question. Okay. Those who want to take a shot, over to you. If you are joining us from YouTube, kindly like the video. 28 are now watching, but only 18 have liked the video. You see a hand with a thumb up. Click on that to like. And then you see a red button. Click on it if you have not subscribed. Click on it to subscribe. And then press on the bell there so that you receive notifications once we are live. A time will come, I cannot share the link. So once I'm live, you then join us. Thank you. Okay, so now that we are done with this, let's move to, if you are moving to question 7, right? Let's move to question 7. Question 7. Question 7. We have devoted this time for financial instruments. It's an examinable IFRS. All examinations, they are interested in financial instruments. Very, very important. Okay, let's move. Question 7. Bismarck prepares financial statement to 31st March each year. The following events have occurred which are relevant to the year ended 31st March 2018. On 1st April 2017, it means that is the beginning of what? 2018 financial statement. On 1st April 2017, Bismarck loaned 30 million to another entity. The underlying word is loaned. The word loan, that verb should tell you that it's a financial asset. Bismarck is the one giving money out. It's a financial asset. So we have face value. To be 30 million. Interest of 1.5 million is payable annually in arrears. So nominal interest, 1.5 million. An additional final payment of 35.3 million is due on 31st March 2020. So redemption value is what? 35.3. Bismarck incurred direct cost of 250,000. So direct cost, that's the transaction cost of 250,000. In arranging this loan, the annual rate of interest implicit in this arrangement is approximately 10%. So the effective interest rate is 10%. Bismarck has no intention of assigning this loan to third party at any time. It means that Bismarck intends to hold on to that loan until maturity. So you state that since they said explain and show how the event should be accounted for. You say that since Bismarck intends to hold the loan notes until redemption. Until redemption. And the characteristics of the cash flows comprise of interest and principal. The financial assets must be measured at amortized cost. So that's the meaning of explain and show. Okay. So initial amount to recognize. Initial recognition. We are going to have the face value. Face value of 30 million. Then we look at the direct costs. Direct cost, how much? Is that 250,000? So if it's 250, it will be 30,000 and what? 250. Or better still, let me pick them in millions, then I move faster. So this is this will be 30 million. This will be 0.25. So making 30.25. Then we'll do the amortization. Effective interest at 10%, nominal 1.5 million. So amortization. We are going to have the years from 20 what? It's for 3 years, eh? They said we should do for only 1 year, but you let me do the 3 years for you. 2018, 2019, 2020. Balance at start. Effective interest at 10%. Nominal interest at, we don't know, but we know it's 1.5 million. Then balance at year end. So balance at start is 30 million. Effective interest, also all figures in what? In millions. So 10% of, you said is 30, balance at start is 30.25, right? And so 10% of that will give us how much? 3.03. So nominal is 1.5. So let's add and deduct the 1.5. How much are you getting? How much are you getting?
31.78.
That 1 point what?
78.
78. So we have 31.78. So times 10% will give us 3.18. So minus 1.5.
$33.46.
33.46. So 33.46 times 10%, that will be 3.35. Then minus 1.5 will give us how much? It should be approximately the redemption value of 35.3.
35.31.
So 35.3. So the redemption value was 35. So it's just a matter of copying it for them. So we have income statements. Income statements. Interest income. We have interest income. Interest income. $3.03, $3.18, $3.35. Then in the statement of financial position. Please, in exams, when they say 1 year, stick to the 1 year, please. Stick to the 1 year. Don't do 3 years to waste your time. Statement of financial position. So you have 2018, 2019, 2020. We have non-current assets, investments. Non-current assets. We have investments. How much? 31.78. In 2020, to be current assets. Current assets. Investments. Right under that, investments. Investments. That is 33.46. So that is all. Any question? Any question? Okay, any question? Let me check if there's any question. Please send all your questions to the chat session so that I can help you.
Hello, sir.
Yes.
Please, one of the questions you said.
Is that
One of the questions you said.
one
It was-
of the?
One of the questions you earlier this morning. It was for liability. So for the current liability, you set it to like 2020. Let's say that 33.46. You set it to
No, your line is not clear at all. The network is bad. Do you mean one of the figures I've written is wrong? Okay. So you talk, let me see if I can hear you, or you the chat session.
So please, is it clear now?
Yeah, it's better.
Okay. So for one of the questions we solved earlier today, it was liability. We're splitting into current and non-current liability. And
Yes.
then for like the 2020, I don't know what year we used, but then it was 3 years like this one. And that last year you put like the 33.46 under the 2020.
No, it's not like that. It was rather under compound, the equity portion. That one you write the same amount for the whole 3 years. You understand? You understand? After the current and non-current, I wrote the equity portion. And then for equity portion is for the whole year. There's nothing like that. How we are there. For the last year, you don't bring anything because if you believe that by the end of the last year, it would have been redeemed. How we are there.
But you wrote something there. I don't remember the name of the question, but I'll look at it.
But if you don't know the question, how do you know I wrote something there? And the equity, I remember I went and wrote equity. The equity was under current liability. Okay, so let's move. Those who want to take a shot, I believe that you have taken the shot. Okay, so let me see live chat if there's any question. From Honorable Kofi, you say that how come coupon rate is higher than effective interest rate? I thought EIR has other embedded rates, so should rather be higher. Yes, you are right, but you see that in this question, it is in a jurisdiction where this asset can be redeemed at a discount. You understand? So long as the asset is not doing well, I mean the asset is not performing well, it is likely that, I mean on the market, if the asset is not doing well, it is likely that at redemption, because in their jurisdiction they allow at a discount, at redemption you are going to redeem at an amount which is less than the face value, and that one too is factored in the effective interest rate, and that is making the effective interest rate to be less than the nominal interest. In our part of the world, it cannot happen because you cannot redeem at a discount, but elsewhere it is redeemed at a discount. It can be redeemed at a discount, so that scenario can happen there. Jeff Dapa, why is investment and a current asset? Yes, because it's left with 1 year for you to redeem. It's left with 1 year for you to redeem. Someone is referring to question 3. Please, what is wrong with question 3? Be specific on your questions so that I can address them. Okay. Let me see the question 3 they are talking about. This one, let me check it with this one. So this is question 3. So what is wrong with question 3? So loan notes, how much? Okay, this one. If you are this one that you are referring to,
Yes, please.
it's supposed to be under 2021. It's 19083. Yeah, it's supposed to be under 2021. Okay, so that is that. If you want to take the solution for question 3, fine. Anybody want to take and take. Let's move straight to question number. If you are on question what? Question 8, right?
Yeah.
Okay, let's move to question number 8. Question number 8. Okay, so let's move. Question 8. Let's go and insert. Like the video and subscribe. Subscribe to the channel so that once we are live, you can join us. You can get the notification. Once you subscribe, press on the bell so that you can join. So, all right, so question 8. Let's look at question 8. Question 8. Bossman prepares financial statement to 31st March each year. The following events have occurred which are relevant to the year ended 31st March 2018. On 1st April 2017, Bossman purchased 500,000 shares in a key supplier, Entity X. The shares were purchased in order to protect Bossman's source of supply, and Bossman has no intention of trading in these shares. I like this statement. Has no intention of trading in these shares. We are now I'm looking at equity investment. Equity investment, we have learned that once you have no intention of trading in the shares, then it will not be compulsory to treat it. I can be measured at fair value through P&L, but it will not be compulsory. You can also, by an irrevocable election, opt to designate it as fair value through OCI. So let's look at the question. The shares cost 2 cedis per share, and the direct costs were 100,000. On 1st January 2018, the supplier paid a dividend of 30 pesos per share. On 31st March 2018, the fair value of the share in Entity X was 2.25. Required, explain and show how the events reported in the financial statement of Bossman for the year ended 31st March 2018. You should assume that Bossman only measures financial asset at fair value through profit and loss when it is required to do so. This is where the issue is. Under IFRS 9, it is compulsory to measure fair value, financial asset at fair value through P&L. That is, if it is equity investment. If it is held for trading, then it's compulsory. If it is not held for trading, then it is not compulsory. But it's the policy of the entity to recognize equity investment or financial asset at fair value through P&L, only if it is compulsory. So now that it is not compulsory, we will not recognize it there. You understand? So this is what we'll do. We'll just say that since the shares are not held for trading, Bossman on initial recognition must make an irrevocable, should be irrevocable, that way. It means that you must make a decision that is irreversible, must make an irrevocable election to designate, must make an irrevocable election to designate the financial assets at fair value through at fair value through OCI, at fair value through OCI. So let's look at the initial amount to recognize. Initial recognition, fair value. You paid how much? 2 cedis per share. So it will be 500,000 times 2 cedis. That will give us how much? 1 million. And our transaction cost, we need to add, since it is not at fair value through P&L. If it was that, then we would have taken the transaction cost to P&L as an expense. But this one we are supposed to capitalize because it has fair value through OCI. So transaction cost is how much? It's 100,000. Shall we? Let's now look at the changes in fair value. So let's go to income statement. We have learned that for dividend, it should be taken to P&L. So P&L will take care of the dividend. Dividend income. They said that is 30 pesos. So 0.3 times what? 500,000. That will give us how much? 150,000. Then we go to OCI. So OCI we look at the difference between, we deduct the initial amount to recognize of 1.1 from the balance at the end of the year. And you know the balance at the end of the year to be. They said that the value has increased to 2.25 at the end of the year. You will see that. So OCI will be, there's going to be, I think it should be fair value gain. Fair value gain, which will be 2.25 times 500,000 minus what? The 1.1 million. That's the initial amount to recognize. So how much are we getting? How much?
25,000.
Next what? 500 times 2.25, how much?
1,125,000.
5,000. So minus the 1.1 will give us 25,000. That not it. Okay. So that will be a fair value gain. In the statement of financial position, we just show the 1,125,000 as a financial asset. So statement of financial position. Remember to be bringing the Ghana cedi, so it's very important. So non-current assets. What is it? We have an investment, that is equity investment of how much? Of 2.25 times the 500,000. That will give us 1,125,000. 1,125,000. So I mean that is all. Okay. You can take a shot if you want to. Okay, let's move to the other side. Yeah. If you have any question, kindly ask. Subscribe to the video, to the channel, and then like the video for us. Once you subscribe, make sure you press on the bell so that you can get notification whenever we are live. Any question?
So please, there are questions on the YouTube page.
Is there?
There are questions on the YouTube
Yeah,
page.
yeah. So I'm looking at it. Is it that the loan note and account liability is posted to final year, which so that one I've corrected it. Then I proposed that I thought fair value gain or loss goes to P&L, Y and the OCI. No, this one is at fair value through OCI. This is financial asset at fair value through OCI. Once it is at fair value through OCI, changes in fair value goes to the OCI. For equity investment, we say that dividend income is always treated in P&L, whether it is at fair value through P&L or at OCI. Dividend income is a P&L item because it's a realized gain. So we now go to equity and then we show capital surplus. It will take that gain we have taken to OCI of 25,000. Okay. Okay, I think I've answered all the questions now. All right, so let's move on to question 9. Question 9. After every hour, my plan is end so that the video will not be long. Okay, so you let's move to question 9. So I want to look at question 9, since you don't have any issue. Question 9. Okay, let's read the question. Johanny prepares financial statement to 30 September each year. During the year ended 30 September 2016, Johanny entered into the following transactions. On 1st October 2015, Johanny made a 3-year loan of 10 million to one tax. The rate of interest payable on the loan was 8% per annum, payable in arrears. On 30 September 2018, Johanny will receive a fixed number of shares in one tax in full settlement of the loan. It means that Johanny is not expecting anything cash. Since it will be settled by way of instrument, then it means that the contractual cash flows does not include interest and what? Principal. There's nothing like principal. So in this case, it cannot be measured at amortized cost. We can only measure it at fair value through what? P&L. That's what it means. We can only measure it at fair value through P&L. One tax paid the interest due of 800,000 on 30 September 2016, and one tax has no liquidity problems. Following payment of this interest, the fair value of this loan asset at 30 September 2016 was estimated to be 10.5 million. So the difference between the 10.5 and the 10 million should also be taken to a P&L. Well, we need to measure it as fair value through P&L. Okay. So you say that the financial assets should be measured at fair value through P&L. Why? the instrument is at a commercial rate. It is, if it's at a subsidized rate, we have a way of dealing with such loans. It is at a commercial rate, and they also made mention of the fact that they will not be any principal, they will only redeem it by shares. And the characteristics of cash flow does not include what? Interest and principal. Because the redemption value is excess, so no principal, meaning you can't measure that amortized cost. You cannot also measure that fair value through OCI. So initial measurement, initial recognition will be 10 million. Then the interest they have paid of 800,000, take it to P&L. So income statement. We have P&L, interest payment, and we know interest payment is 800,000. Let me make it interest income, 800,000. Then there was a fair value gain, that is a 10.5 million minus 10 million. That will give us 500,000. Statement of financial position. Statement of financial position. We have assets. So what is the assets there? Non-current assets. We have investments. I'll write it in full here. Non-current assets. So that is the 10.5 million, right? 10,500,000. So that is all. Very simple and hot, and then straightforward. The explanation is very important. Very, very important. So set a question. Just solve it simple like this, then we move. Okay, so you can take a shot if you want. All right, so let's move to question 10. Question 10. We are still on financial instruments. You just want to understand financial instrument. Any question on financial instrument, you need to take your time and then fix it. Today we are fixing financial instruments. We'll take our time and then come and fix any special. We'll fix it. All right, let's move. Let's move to question 10. Okay, let me check on the YouTube page if there's any question. Any question? Any question? Is there any question you want to ask? You can send it on the chat session so that I address them for you. Okay, let's move on to question number. Let me see. If you have any question, kindly send it on the chat session so that I address it for you. I said that if your screen is not clear, there's some round shape there. Click on it and select higher picture quality to be clear more than to be clear. Yeah, those who said I should go over something, please. After that, the video will be on YouTube, so you can always play and play and play. In this question, I'm explaining that you see, it wasn't at a subsidized rate. It is at a commercial rate. And they said that instead of paying cash as principal, as redemption, they are going to issue shares, meaning there's nothing like principal amount payment. So it cannot be measured at amortized cost. Neither can it be measured at all at fair value through OCI. So it will be left with at fair value through P&L. All right. So that is, I think I've explained. Amanda, I think you have a problem with your network. Select higher picture quality and to be clear more than to be clear. Okay, so let's insert the next one. Okay, Eunice prepares financial statement to 30 September each year. During the year ended 30 September 2016, Eunice entered into the following transaction. So on 1st October 2015, on 1st October 2015, Eunice purchased an equity investment in entity Y for 12 million. The investment did not give Eunice control or significant influence over entity Y, but the investment is seen as a long-term one. Once it is seen as a long-term one, you see, the default method is that it should be measured at fair value through P&L, is correct. But we must again state that since it is held in the long term and not part of a trading portfolio or not part of a portfolio of assets held for trading, then it can also be measured at fair value or OCI. So both of them is correct. You have to explain it well. On 30 September 2016, the fair value of Eunice's investment in entity Y was estimated to be 30 million. Explain and show how the above should be recognized. So, explanation very, very important. You only say that the equity investment can be measured, at can be measured at fair value through P&L. Since that is the default method, in that case, initial recognition will be 12 million. And then in the P&L, you recognize fair value gain of 30 million minus 12 million. That will give us how much? 1 million. You can also say that it can also be measured at fair value through OCI. So let me rewrite that. You can say that since the investment is in the long term, also since the investment is in the long term, rather than part of a trading instrument, that is a portfolio of instruments. The name of the entity, Eunice. Eunice can, on initial recognition, make an irrevocable election. Unis can make an irrevocable, let me say, on initial recognition, since the investment is in the long term rather than part of trading instrument. On initial recognition, Unis can make an irrevocable election to recognize or to measure the equity investment at fair value through OCI. In that case, the initial amount to recognize will be the same, 12 million, but the changes in fair value go toward OCI. In that case, initial amount to recognize will still be 12 million, but the changes in fair value, that is OCI, will take fair value gain. The OCI will go to capital surplus as well. So we'll take fair value gain of 1 million, which is a fair value gain will be 13 million minus 12 million. So the only difference in the treatment is that the fair value gain, if it and the fair value through P&L, the fair value gain goes to P&L. Then and the fair value through OCI, the fair value gain goes to what? Goes to other comprehensive income and is taken to capital surplus and equity. You can do the extract or you present it raw like this. That's all. What is important is the explanation. Very important. How you understand to articulate your answers like the way I'm doing. That is where the problem is coming from. Fine. Okay. So let's see. You can take a shot. We are done. Any question, please? Any question? Any question on the question 10? Unis limited. Any question? Any question? If you I believe you understand.
Yes, please.
Okay. Let's move on to the next question. Question 11 and question 12, we are looking at an interest-free loan and a loan that is given at a subsidized interest. Very simple and straightforward. So question 11. All right. So let's look at this question. This is an interest-free loan. Interest-free loan is very simple. In fact, in accounting, there's nothing free. Just like the accounts people will tell you that there's no free lines. You understand? There's no free lines. So what do? In fact, you are given an interest-free loan. We will say that we will find the present value of the amount the person is supposed to pay to you. Then the difference between the present value and the future value will be treated as a loss. And then we amortize it to treat an interest income. There's nothing like free. You have to treat it. So take note. Interest-free loan, you still treat it. Look at how it is treated. ICA Limited. ICA Limited prepares financial statement to 30th September each year. During the year ended 30th September 2013, ICA entered into the following transaction. On 1st October 2015, that is at the beginning of the current year, ICA made an interest-free loan to an employee of 800,000. The loan is due for repayment on 30th September 2017. And ICA is confident that the employee will repay the loan. ICA would normally require an annual rate of interest of what? 10% on business or loans. So we are going to use this 10% to discount that 800,000. Is it that you pay on what? 30th September 2017. So that's for how many years? For 2 years. For 2 years. Explain and show how the above transaction would be reported in the financial statement. So initial recognition. Initial recognition. The investment should be measured at fair value. Should be measured at fair value. Fair value is equal to the present value of all cash flows. The present value of all cash inflows. All cash inflows. So how much are you going to receive? The same 800,000 in 2 years' time. So it's going to be 800,000 times 1.10 raised to the power -2. So but how much are you getting? $661,157.
157.
Okay. So you now recognize a fair value loss, or recognize an expense recognized as expense a fair value loss. That is expense. The difference between the future value, which is the 800,000, and the fair value today. In fact, the amount you are giving to the person today is face value. Let me use that one so that you understand. The face value today, how much you are giving to a person today, is 800,000. But when you compare the amount you are going to get, it is far less than 800,000. So that difference is a loss. That is 661,157. So recognize it as a loss. Loss on loan. That is 800,000 minus 661,157. That is 138,843. And after that, we carry the fair value, that is the 661,157 at amortized cost. So subsequently, the fair value is carried at amortized cost. So you have the years 20. Okay, they said 2017 and 2018, right? I mean, it is with Marble in 2018 also. It is Marble in 2017 rather. So it's 2016, 2017. 2016, 2017. So balance as tax, effective interest. There's nothing like nominal. So balance at year end. Balance at year end. That will be 661,157. Please, what's the effective interest? 10% of that will give us how much? 66156, right? Let's add, how much are we getting? Madam, are you there or you are sleeping?
727313.
Eh? I can't hear you. Okay, 727313. Now I'm pointing my own thing. Or you are tired.
I'm here.
You are far away from your phone or something. I can't hear you. So 10% will be 72731. So plus 727. So 800,044. So approximately 800,000. You understand? So approximately the 800,000. So that is all. So income statement. (2016, 2017) P&L loss on loan is 138,843. Then you bring interest income. 66,156, 72,731. Then you bring current assets. So assuming we are in the books of the issuer, I mean, we are in the books of the one who took the loan. The fair value loss you see there would have been a fair value gain, and this one would have been finance cost. Very simple. So statement of financial position. We have current assets. Current assets. Investments. That is 72,727,313. Okay. So that is that. So those who want to take a shot, let me off my video. Those who want to take a shot, you can do that.
So if you are answering the question,
Yeah.
if you are answering the question, with this question is for just 2016. So when you're amortizing, you have to amortize, you stop at 2016. You don't do the rest.
Yes. Yes.
Okay.
Because 2017 is not part of the question. So the question is only testing you on whether you know that you know how to treat it. I get it. This one, if you know, you know. If you don't know, you don't know. If you know, you know. If you don't know how to deal with it, you don't know. So let's take another one where there's a rate of interest, but it's a subsidized interest. You understand? Question 12. It's a subsidized or interest. Let's look at that. Okay. I think after that we can end. And maybe another time we can look at maybe Sunday morning. I can look at the final part 3, the last 4 questions. Otherwise, I'm going to stress you so much for a day. All right, so let's look at it. Question 12. So I think I will check your questions, but I believe you people are fine. Question 12, unsubsidized loan. One side has made a loan of 50 million to a charitable organization for the building of new sporting facilities. The loan was made on 1 June 2016 and is repayable on maturity in 3 years' time. Interest is to be charged 1 year in arrears at 3%. But one side assesses that an unsubsidized rate for such a loan would have been 6%. So they are giving them 50% cost. No accounting entries have been made for the year ended 31st May 2017. So we will look at the whole 3 years. Show how the following should be accounted for Barbara to the other. All right, so let's look at it. So one time made the loan. So you know that they are talking of asset. Made the loan of 50 million to. Okay, so as usual, we say that on initial recognition, one touch must recognize the investment at fair value. And what is the fair value? Fair value is equal to the present value of all the cash inflows. If you are using FM, then when you have to apply your 3% on the 50 million, but how much will you get? 3% on 50 million, you get how much? How much? Oh. Damn, you are not helping me again. So that is 1,005 or 1.5 million. So you say 1.5 million. What about by 1 minus 1 plus 0. We discount using the effective rate, that is the correct rate, the unsubsidized rate of 6%. So 0.06 with the power is for how many years? 3 years, -3, all over 0.06 plus they will pay the redemption value of what? 50 million too. So 1.06 is upon -3. So this is the present value. So this can be calculated like the way we have been calculating like this. We have the year 20. So it was the loan was made on 1 June 2016. So we are looking at 2017, 2018, and then 2019. So let's look at the cash flow. Cash flow. So the cash flow, we are going to have the 1.5, that is 3% of 50 million. It's 1.5 million. So it will be 1.5 million, 1.5 million, 1.5. I remember in the last year, you paid the 50 million too. I mean, they will pay the 50 million too. So plus 50 million for the last year. So we now discount using the unsubsidized rate of interest of what? 6%. So 1.06 with the power -1. That is 0.9 943. 1.06 to the power negative 2. That is 0.890. 1.06 to the power negative 3. That is 0.8840. Okay, so let's multiply. 1.5 times 0.943. So I'm coming.
1 point.
Let me write the figures in full. This 1.5 million. This 1.5 million. This is 51.5 million. So the present value give us how much? The first one.
1 million.
Now what's wrong with your network or you are tired? 1414 500. I can't hear anything from you. 1.5 times 0.890. 1,335,000. 43,260,000. When we add plus 1,335 plus 1,414 46. Okay. So there's a fair value loss that we need to recognize, or loss on loan. So loss on loan. That would be 50 million minus 46,009. That would be 3,990,500. This is a loss on loan. So now we measure the loan assets there at amortized costs, the 46. So subsequent measurement at amortized costs. At amortized costs. So we have the year. We have the year. So we have 2017. So 46 So let's put some 3 zeros on top. That will be 46. Since I've written the full figures, 46,009,500. So effective interest at what? At 6%. Then nominal interest at 3%. Then balance at year end. So 6% of the figure. So this is 2,760,570. So nominal is 1.5 million. You know that. So minus 1.5 million. Then we add the 46,009,500. So 47270070. So 47270070. So times 0.06. 283,6204. So minus 1.5 plus 472,700. 4860
4860
606 606,274. And then if you are doing one corner, 4860.
Hello, sir.
Yes. So help me, 6% and that. That would be 2916376. So minus 1.5. So we get something around the 50,000, 50,106, 273. We see it as approximately what, 50,000 because of the error of approximation. If you use the formula approach, your answer will be close to the true value. And this one, there were approximations. Okay. So that is it. You copy the effective interest as interest income. So to be like this, income statement extract. Income statement extract. P&L. There's going to be loss on loan. That is 2,760,570. Then 2,836,204. then 2916. So 2017, 2018, 2019. All right, so statement of financial position.
So I was thinking the loss on loan is at 3,990,500.
What is it? Out. So this one is for other interest income that I've copied there.
Yes, please.
So interest income. This interest income. Then the loss on loan. Loss on loan is 3,990,500. So dash. Statement of financial position. Financial position. We have non-current assets. We have investments. That is 47270070. Then that is 2017, 2018. Then it becomes current assets. Becomes a current asset in 2018. That is 48606,274. 2019 to be dash. So that's all. It's not difficult. You just have to know how it is treated. I get it. You first pick the fair value. Fair value, the present value of all the cash inflow you are going to receive. And after that, you amortize that fair value. Make sure you calculate the loss on loan. Once you are the one giving the loan, you have a loss on loan and interest income. But if you are the one receiving the loan, then you are going to have gain on loan, the same treatment. But you will have gain on loan, and instead of interest income, you will have finance costs. Very simple. If you want to take a shot, you can start from this side. Let me increase it. Okay.
Say your video.
Okay. All right, so as you move to the next slide, I can move right. Right, if you have any question, can you let me know? We are left with 4 questions. Ideally, we may have to do that on Sunday morning. On Sunday. So that is it. So tomorrow I'll work on any special, and then I'll let you have the document, but I will look at it. Okay. So let me check on the, please, if you have any question, can you send it on the page? On the YouTube page, if you have any question, let's see it. Go to the chat section. Any question? Okay. I believe that the class has been very fruitful, concentrating on financial instruments. It's very examinable. We'll look at earnings per share as well, which is also examinable. Then we'll look at borrowing costs that make that together. So from now till the next week Saturday, it will only be on IFRS. All right. So on this note, we want to end on question 12. We have 4 more questions to go. So you see financial instrument part 3, that is Sunday morning. Shall we pray? Heavenly Father, we thank you so much for how far you brought us. We pray that the little you have learned today, you bless it for us so that that day we can write our exam and pass. In Jesus' name, have we prayed with thanksgiving. Amen.
Amen.
Thank you so much, Madam Efia, for joining class figures on this one. Thank you. So see you Sunday morning. Subscribe to the channel so that once I'm live, you get notification. Once you subscribe, just press on the bell to get all notifications. Also, just like the video. The thumb up, just click on the back, then you like the video for us. Thank you so much. Bye-bye.